Let's get more on the U.S. economy with Steve Kyler. He's a professor of macroeconomic policy at Cornell University. Steve, thanks for joining us.
Thanks for having me.
So, Steve, first quarter GDP marking the economy's worst performance in 2 years. How big of a concern is this?
Well, there's no question about it. It was a pretty poor report. But I don't think there's reason to get too upset about it. I do expect things to improve somewhat later in the year. There were evidence, various pieces of evidence in this report give grounds for optimism. One of them is that though personal consumption expenditure didn't grow as fast as expected, unemployment's way down. Wages are up. That would put a floor under consumption expenditures in the future. So it's pretty clear that the money is there, the jobs are there, and people should start spending money, even though again, as with some other economists, I don't expect a huge surge. Another very bright spot was residential investment. Now, that is, in a typical business cycle, a leading indicator, one that tends to turn up first. Business investment, which did take a big hit this last quarter, was low primarily because of a complete halt in energy investment, or a pretty nearly complete halt. And there's only so far down that can go. Once it's at a dead stop, it's done. And we shouldn't see further negative influence from that in the future. If you take out that from business investment, it wasn't looking nearly as anemic as the overall figures would have seemed to indicate.
And, Steve, considering there was tremendous market volatility in the first quarter, concern about global growth, and as you mentioned, the U.S. also adjusting to that commodity plunge, it was expected for there to be a pullback under these circumstances, right?
Yeah, there certainly was. And I might add, and this is really an uncertainty, this is the third year in a row we've had a very dismal first quarter report. And so there may be something going on there that the data really aren't fully capturing.
Still down by 2 basis points from what was expected. Does this call in question the Fed's decision to hike in December?
Well, I was never a fan of that. But the fact is that 0.25% really isn't going to make that much of a difference. I do think, judging from the Fed's latest minutes, that they are unlikely to raise rates in June. Only one of the voting members of the Federal Reserve Board was in favor of raising them this time. And it does seem unlikely that it's going to happen in June, at least based on the evidence we have now.
Well, one of the effects of the Fed hiking interest rates was the strengthening of the dollar. That seems to have leveled off a bit. So does that bode well for next quarter?
Well, and we could also say the strength of the dollar had its influence on the GDP figures today. Imports were up because of the stronger dollar. Exports were down. But it does seem that with uncertainty resolving itself, at least from what we can tell right now, that may have settled to a level that is going to stick to for the next few months. So I wouldn't expect that to have a major effect on what the Federal Reserve does if it does stay more or less where it currently is.
Steve, there was always a big focus on China. How significant is the slowdown in growth of China's economy to U.S. GDP?
Well, of course, it is quite significant. China's exchange rate now is biased the other way. It's trying to fall rather than rise, as had been the case for many years, and which U.S. policymakers constantly complained about. But it's really more uncertainty there than the actual levels at the moment. The Chinese data don't necessarily reflect everything that's going on in the Chinese economy. And so the uncertainty there does give one pause and adds to the overall uncertainty. And I have to say, Europe doesn't give one cause for great confidence all the time either. There are reasons to be nervous about that as well. And I think that overall uncertainty, in addition to U.S. domestic factors, does have a restraining effect on all of the spending that we're seeing.
Steve, corporate tax has been a big issue lately, particularly with the administration's crackdown on inversion. Companies reducing investment in the U.S. because of that high corporate tax rate, and what would the impact be of a lower tax rate?
Well, I don't think that companies are going to invest a whole lot if people aren't buying their stuff. Really, the demand has to be there for companies to want to invest. But again, I'll just say it once again, that business investment tends to be a component of investment that follows residential. And with residential investment up 14 to 15% this last quarter, business equipment and software, if you take out the energy sector, probably around a 0% if you average over the last few reporting periods. It may well turn up in the future also, especially if the increases in wages and employment follow through to personal consumption expenditure, as you might well expect them to.
Steve, thanks so much for your insight and analysis. Steve Kyler, Professor of Macroeconomic Policy at Cornell University.